Apple is building its own modem, engineering itself out of a relationship that helps power nearly all of Qualcomm's cash. Chinese phone demand has softened. The two engines that generate almost every dollar this company earns are both under pressure at the same time, and management's answer is to spend aggressively chasing a market it has never competed in: artificial intelligence data centers. So which is this, really a credible reinvention, or an expensive hedge against a shrinking core? That question hangs over everything. A stock trading at $176, down sharply from its high, throwing off more than $12 billion in cash a year. Priced by a market that cannot decide whether it is watching a cash machine hold firm or a franchise quietly beginning to erode. By the end, you will have a grounded answer either way. By the end of this, you will understand exactly how Qualcomm makes its money, why its reported earnings just fell 44% without the business actually weakening, how much cash it truly generates, what the data center bet could be worth, and the one development that would prove the whole thesis wrong. Real numbers, computed from the filings, not headlines. Two businesses sit under one roof, and they are not equally good. One designs the Snapdragon processors and modems inside phones, cars, and connected devices. The other owns the patents, the standard essential inventions that make cellular work, and collects a royalty on essentially every third, fourth, and fifth generation phone sold, no matter whose chip is inside. The revenue split is lopsided. The chip arm brought in $38.4 billion last year, roughly 87% of the total. Licensing added just $5.6 billion. Yet that smaller slice punches far above its weight because licensing royalties carry margins in the high 60s to low 70% range. Look closer, and the real exposure is not one customer, but one end market: smartphones. Roughly 7 of every 8 revenue dollars flow through chips tied to phones. Apple is the sharpest single thread, a major modem buyer and a licensee at once, and it is actively engineering its way out of both. The top line has been a rollercoaster, not a straight climb. $33.6 billion in 2021, a peak above $44 billion the next year, then a slump back to $35.8 as the industry worked off excess inventory before recovering to a fresh high of $44.3 billion last year. Operating income tells a cleaner story than the headline. It reached $12.4 billion last year, up 23%, back above where it sat before the downturn. The 2-year collapse was a classic chip inventory correction, and the business has climbed its way out of it. Then there is the number that looks like a disaster. Diluted earnings per share fell to $5.01, down from almost $9, a 44% drop. But pre-tax income actually rose. The entire decline came from a one-off tax charge of more than $7 billion, not from anything wrong with the business. Profitability held up far better than that headline implies. Gross margin sat at 55.4%, barely off its peak, and operating margin recovered to 27.9% from a low near 22%. Pricing power in the premium chips and the licensing franchise stayed intact even as the mix shifted. Staying at the leading edge is not cheap. Research and development absorbs around 20% of revenue, about $9 billion a year, funding both the next process node and now the data center push. That intensity is not coming down. If anything, the new ambitions demand more of it. Returns on capital are where the quality shows. Return on capital employed came in at 30% last year, and the business has earned north of 18% on operating capital every single year shown, peaking above 40%. Even the tax-depressed net income return comfortably clears any reasonable cost of capital. Cash generation is the strongest fact in the whole file. Free cash flow reached $12.8 billion last year, more than double reported net income, and it has grown every year since the downturn. On light capital spending under 3% of revenue, this is a business that simply throws off cash. None of this rests on a stretched balance sheet. Net debt sits at just $8.5 billion, a mere 0.57 times earnings before interest, taxes, depreciation, and amortization. With interest coverage a non-issue, no lender is going to force this company's hand during the transition. Almost everything earned goes back to shareholders. Buybacks jumped to $8.8 billion last year, more than double the prior year's pace. Combined with dividends, the company returned roughly $12.5 billion, essentially its entire free cash flow haul for the year. The dividend is both generous and safe. On a per-share basis, it has climbed steadily to $3.44, up from $2.62 4 years earlier, and it consumes only about 30% of free cash flow. There is ample room even if cash flow dipped. Buybacks have shrunk the share base, but only gently. Diluted shares have drifted from about 1.15 billion to 1.10 billion, roughly a 4% reduction over 4 years. The offsetting drag is nearly $3 billion a year in stock-based compensation, quietly refilling the pool. Then the pattern breaks. Qualcomm agreed to buy a company called Modular for $3.9 billion and paid entirely in stock. Issuing equity to fund an artificial intelligence software play after years of buying its own shares back reverses the whole logic and adds dilution right when the payoff is still years away. A business does not earn between 18 and 40% on its capital for 5 straight years through a bust and a recovery without a genuine moat. Here it comes from 2 places: a wall of standard essential patents that makes a modern phone almost impossible to build without paying, and hard-won engineering scale in premium mobile chips. But the moat is being tested at its foundation. Apple's in-house modem is a direct assault on the chip franchise, and its licensing dependence is set to fall. Meanwhile, the data center arena Qualcomm is charging into offers no protection at all. There, NVIDIA's software ecosystem is the moat, and Qualcomm is the outsider. Where this lands on value and the single risk that could break it is coming. But first, the world this stock lives in. The backdrop is hostile. Rates have been climbing and high multiple chip names have borne the brunt of a sharp sell-off, with the group shedding roughly $1 trillion in value in weeks. Qualcomm amplifies every one of those swings. With a beta near 1.6, it moves harder than the market in both directions, and the sector sits at a nervous late stage of the artificial intelligence spending cycle, enormous investment, and mounting doubt about when it pays back. The share price tells that story of caution plainly. At $176, the stock sits well below its 52-week high, near $260, and in the lower half of its yearly range. Sentiment has turned careful, even as the underlying cash flow holds firm. The catalysts are concrete and dated. At its June Investor Day, Qualcomm launched a data center line called Dragonfly and set a target of $40 billion of non-handset revenue by 2029, with Meta named as a processor customer from 2028. These are the proof points that matter. The timeline, though, demands patience. Sampling happens this year, but meaningful revenue does not arrive until 2028. That long gap is exactly what triggered a prominent downgrade: a lengthy development horizon, higher spending, execution risk, and no near-term offset to the cash going out the door. The honest way to value this is on cash, not distorted earnings. Against a market value near $186 billion, that $12.8 billion of free cash flow is a yield of about 6.6%, before crediting a single dollar of the data center ambition. Build a discounted cash flow frame on that base and the demands are modest. Grow that cash at 4% forever and discount at 9%, and the equity is worth roughly $265 billion. Ease growth to 3% at a 9.5% discount, and it falls near $200 billion. Today's price sits inside that band. That brackets a fair value range of roughly $170 to $220, centered modestly above today's price. In plain terms, the market is paying fair value for the existing cash machine and assigning close to nothing for the transformation, while also pricing in some erosion of the core. Wall Street lets you test the assumptions directly. The consensus sees revenue nearly flat near $43 billion through 2027, then accelerating to $50 and then $60 billion by 2029 as data center ramps. Earnings per share follow the same shape, from $10.76 to $16, a compound climb above 14%. On today's price, enterprise value sits at about 13.5 times earnings before interest, taxes, depreciation and amortization, right in the middle of its 5-year range, neither cheap nor dear. And on next year's expected earnings, the stock trades near 16 times, below what most artificial intelligence chip names command. That last point is the crux of the whole debate. At about 16 times forward earnings, the market is treating Qualcomm as a mature, mildly declining franchise, not an artificial intelligence growth story. If the later acceleration towards $16 of earnings arrives, that multiple looks cheap. If it stalls, it looks fair. What could break all of this? The dominant threat is Apple's modem exit. Qualcomm is guided to supply only about 20% of Apple's 2026 modems, phasing towards zero by 2028. The signal to watch is handset chip revenue falling year over year while the new businesses fail to fill the hole. The second danger is that the data center bet eats capital and stock without earning its keep. Watch the operating return on capital if that roughly 30% figure erodes toward the low teens while Dragonfly revenue stays negligible. The Moat thesis weakens materially. A slipping Meta or Microsoft design win would be the clearest tell. The third risk acts faster than any of that. With its high beta into a rising rate valuation compressing sell-off, the stock can fall well before any fundamental proof arrives. And if China's handset market stays weak past its expected bottom, it delays the recovery the entire model assumes. Weigh it all, and Qualcomm looks fairly valued with a favourable skew. Neither a credible reinvention fully priced in, nor an expensive hedge doomed to fail, but a cash machine yielding close to 7% with a data center option the market values at almost nothing. The reinvention is real, unproven, and essentially free at today's price. The single biggest risk stays Apple shrinking the core faster than Dragonfly, and automotive can rebuild it, leaving a company that spent heavily just to stand still. Everything here is an educational analysis of publicly available information, not investment advice, and not a recommendation to do anything with this or any stock. Do your own research and consider your own circumstances before making any financial decision. If this breakdown sharpened how you see the stock, subscribe, it genuinely helps. And drop a comment with the company you want analysed next in this same numbers first way. Thank you very much for watching, and we'll see you next time.